So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Juan Vargas. Juan is an accredited multifamily investor based out of Houston, Texas. He has been involved in all aspects of real estate investing within multifamily since 2016. He has transacted on 1,600 plus units valued at over 125 million throughout Austin, Dallas, Houston, and Phoenix, and he's a JV partner on an additional 500 units throughout Texas and Georgia. In addition, he is a limited partner on over 1,000 units. Juan heads operations and asset management at Genwealth Capital Group. He is also heavily involved in acquisitions through broker relationships and strategic partnerships. Juan, welcome to the show.
Hey, thank you so much. I certainly appreciate you sending me an invite, and look forward to adding value to everyone listening here on the podcast.
Absolutely. Likewise, we're very excited to have you. Let's go ahead and jump into it. You've been in the game now for 6 years, which is awesome. You've got a lot of experience, which we'll definitely tap into, but take us back to the beginning and, where you started and what brought you to commercial real estate.
Yeah. So in the beginning, I was, working W-2, and I was, it got to the point where I wanted to make a change, right? And I think everybody, that's in W-2 can also feel the same, right? And so I started looking for ways to create, passive income. One of those ways was real estate, right? It's just one of those natural fits, easy to understand, and it's everywhere, right? So I got into single family, did that for a little bit, and I quickly realized that single family wasn't the best route for me to take. And that was simply because I was relying on one person, right? So 100%, one person, and so that person leaves, and you're vacant 100%, right? So I didn't realize that multifamily, because of the higher number of doors, because of the scale, because you're actually operating a business, was the better option for me. And I went that route and never looked back. And the single family homes that I had I actually ended up selling them. And that's it. Yeah. Just you make sure to close that chapter and focus on the 100% multifamily.
So you mentioned you sold out of all your single family. Did you start as a passive investor in multifamily and commercial?
Yeah. So my first deal was a 32 unit. And that was a deal that we acquired like direct to owner. And we managed it, right? We owned and operated it. So, to answer your question, my first deal wasn't a passive investment. But going through that specific deal did help me to understand, the business a little bit better. And, I wanted to diversify afterwards, right? So that's when I got into my first passive deal. But my first couple were GP, owner operator deals.
And where did you find the team that you partnered with all this on?
Yeah, so the very first one was myself, and I brought on a partner who was a general contractor, and so that was a good actual partnership, because he was able to do a lot of the work and make sure that things were done right on time and for the right price, right? So that was good. For larger deals, that I was a part of a GP team on. I had some good relationships with some folks that were local. They were further along in their careers than I was at that point, and so we built a good relationship, and I was able to come on as a GP and help them, in the process, and also help myself and with experience and really learning the entire procedure and process, right, that you go through when buying deals, right?
Absolutely. Yeah, it makes perfect sense. I love it. And it's so important, especially in the beginning, to build those relationships and obviously have, good partners that you can learn from. So what are some things in the beginning, that you learned from these experienced partners and your experiences that help kind of shape your your philosophy for Genwealth today?
Yeah. So I would say that at the very beginning, underwriting, for the team, or for myself, more specifically, I didn't account necessarily for a lot of capex, right? So it was just more of okay, I think it's gonna run like this, and I think this is gonna cost me this much, and so it was more of a light, capex, budget, and moving forward, what I learned was that you should try to fine tune as much as possible, and also have a contingency there, as well. And the last thing you want to do ever is really do capex items from operations, right? So operational cash flow that you have, should be used for distributions. It should not be used for any capex items that you have at the property, right? Unless you're in an extreme situation where you need to take care of those items, and you're dealing with draws, or in the middle of draws or something, right? But yeah, that's one of the things I learned. I learned that really having a good team on site is very key. You can go with whatever property manager that you want. They're all, at the end of the day, more or less the same. As long as they work on a specific asset class. But I think really knowing who you're dealing with at the property level it makes all the difference in the world. So just a few things that I learned there, among many other others as well, but just a couple of things that popped into my head, from the get-go.
I love it. Yeah, really, really good insight there. Any strategy in the beginning with underwriting, so newbies can kind of, like, is there a rule of thumb for capex, for instance, in order to make sure that you're allotting enough and you raise enough for those expenditures?
Yeah, so I would say definitely on the contingency there, we can have like a rule of thumb, say it's anywhere from 10 to 20% for a contingency, right? So you're underwriting and you have $1 million in capex, then make sure that you're also underwriting, in addition to that $1 million, you're underwriting an additional 10 to 20%, because of any surprises that can happen. But as far as rules of thumb for specific items, the way we have been able to really sort of fine tune that is, after so many deals, you kind of understand what things are going to cost, and so we have like a placeholder that we use for those items. So for example, if we're doing stainless steel appliances, for a specific unit, then we'll add in $2,300 bucks. If we're doing backsplash, then that could be anywhere from 5 to 800, depending on the size of the kitchen, the size of the floor plan, right? Then you're doing flooring. I mean, that's another thing that you can add. So there's specific things that you can have to really fine tune your underwriting, and it depends on what market you're in. It depends on the asset class that you're working with. It also depends on the quality of the material that you're using. So it's a pretty big range. But for the kind of deals that we're looking at that are B, C type properties in Texas, we have a pretty good range of where we think that we need to be at, right? So I think it's very important that everybody kind of fine tunes that, and even potentially even work with a GC during the due diligence process to really try to fine tune that before you actually go into closing.
Absolutely, yeah, makes perfect sense. So a couple questions here. One, is there a certain unit mix that you guys would rather have, or I guess a preference, or does that not really matter? Is it more kind of the value add thing? And then you guys are vertically integrated, correct? So,
we are not vertically
okay,
integrated
so
at
what's
the moment,
it like then? Let's start with the first one. Is there a specific unit mix that you have a preference on?
Yeah, so we always like we like to have a balance, with the floor plans, right? So if we're gonna have ones, twos, threes, fours, we prefer not to have like the majority being ones, right? Where it's like 75% or higher, on ones, and then you're getting 25% that are twos, threes, fours. So the more balanced that we are, the better we like the deal. There's a big demand for twos, especially here in Texas, here in Houston. There's a demand for twos, so we like to see twos in there. But yeah, overall, making sure that we don't have too much of studios or too much of ones, being the majority of the floor plans in a specific property.
Yeah, that makes sense. And it's definitely market by market, right? As to what, residents or tenants typically want in that market. So along the lines of general contractors, what are some things, what's important in terms of developing that relationship? Obviously, everybody's so busy right now, right? There's labor constraints, materials, different things like that. So what are some things, that you guys have found that work really well to maintaining good, GC relationships?
Yeah, that's a good question. I have a few strong relationships that I have. With GCs, and so really, what I have found is that if I if if we need certain jobs done, give these guys an opportunity to bid, right? They're not always going to win the job, but if you always give them an opportunity to bid, then that helps to build a relationship, right? And because we're in different markets, right? Here in Houston and also in Austin, we use the same GCs no matter what, right? We have tried other GCs, like for example in Austin, we've tried other GCs. We found it to be more difficult to work with. One, not as efficient as we like, two, but then it also helps to really strengthen the relationship that we have with our current GCs that we have in Houston. Get those guys out there, give them a room, which is what we've done, in the past. Give them a room at the actual apartment, like a vacant unit. They can have their guys stay there and really be efficient. So it helps them saving costs, helps us to save as well, and really get the job done. And so we understand the kind of work that they already do, and pricing is very similar. Within between the two markets. And so yeah, to answer your question, it's just about staying in front of them, making sure that they have the opportunity to bid on different projects, but also making sure you take care of them whenever there's a job. And then I think once you award them a specific job, making sure that you pay them on time, because there's no other situation where it can be worse for a GC, where if they need funds up front to get the job started or kicked off, make sure that you're paying that mobilization fee up front, and then also ongoing like draws or requests, make sure that you take care of those items on time, and then they'll be happy, right? Because they have materials and they have guys to pay for labor. So it just makes their job easier, makes our job easier. So communication is key overall, is what I would say. But and making sure you pay them on time is also key.
Absolutely. Yeah. Really great insight there for sure. Definitely. I mean, we all want to get paid on time, so definitely can't blame them there. Love the concept of offering up a room as well for their guys to stay on. Obviously, you don't hear that too often, or at least I haven't. So just, one more thing, in the tool belt to kind of add that value to them and take care of them. So they take care of you, because as we all know, finding a good, reliable general contractor is very difficult.
Yeah, so that's a good point. But I guess going back to that room or that unit that you may have and provide for them. So a couple of things happen there, right? So number one is they want to win the job, right? First of all, right? So if they have to pay for lodging, then they have to add it to the bid somehow. They have to squeeze it in somehow, right? So then it reduces their chances of possibly winning the job, because then you might go with contractor B because they're a little bit lower, and you scale it, right? It multiplies and it adds up pretty quickly. So number one is they're able to be more competitive on pricing, and then number two for you is that you're obviously able to get it at a lower price, but you're also working with a GC that you understand and you already know, and just works out really well. So we've done that, and we're continuing to do it actually as we speak, with the GC there in Austin, and it works well, right, for both sides. And I think we both appreciate it, right? So yeah, it's maybe something that somebody can use for their own projects as well.
Absolutely. I love it. Again, really great insight. So what are some things now as we move forward? Obviously, some changes in the economic landscape. I think relatively speaking, interest rates are still pretty solid in the commercial space. I know we're working on a loan right now for a development deal that we're doing here in Utah for self-storage. And, compared to residential, interest rates for our loan are really a lot less, almost a whole point. So what are some things that, you're seeing in terms of changes in the economic landscape and anything you guys are doing differently potentially as we move forward?
Yeah. So I think, as far as any changes that are happening in the market, I mean, we look at so many deals, we underwrite so many deals, we make a bunch of offers. I think that what we have seen is that pricing is still king. It's not changing. I don't think that will ever change. But if a broker has a pricing guidance where they're trying to target, we're seeing that these deals are still hitting that target, and even going over still. It's not as competitive as it was maybe 3-4 months ago. But the guys that are going in and making offers, they are certainly being competitive. So you're not getting the same number of offers, necessarily on deals, but it certainly seems like it's very competitive still. As far as underwriting for these type of deals, I think one thing that's very important that I don't see a lot of groups doing is that they're not necessarily underwriting the forward curve on SOFR, right? I think most deals nowadays are bridge, and so if you're doing bridge, then you're going to have like a rate cap, and if you're having a rate cap, then you got to understand how the SOFR is going to adjust here with the future, and our model takes that into account, right? So what I'm seeing a lot out there is that a lot of groups are underwriting a certain number. They're thinking they're being conservative and saying, hey, my rate right now is a 4.25. If I do 4.5 all the way across, and then I think that's pretty safe and pretty conservative. But I find that not to be too conservative. I think you have to underwrite that forward curve into your model, and it really does hurt the returns if you do so, right? But you're being more accurate with your underwriting, and whenever you do have an opportunity to present to investors, you feel more comfortable knowing that you did the best you could to underwrite. So I think that's a key item there, that as more and more groups are seeing this as a real threat, to their underwriting, they're looking at it, but they're also readjusting, and maybe we'll start to see some groups come in there with a little bit more or less aggressive offers, as you account for that. So yeah, I seen a lot of folks also use bank loans, and so the problem with bank loans is that they can be recourse, or they can have a limited recourse piece to it. And so, but the thing about bank loans is that you can have a fixed debt, and it'll be likely lower leverage, but can have fixed debt, and then on top of that, they're maybe coming in with a pref piece or something, right? So a lot of different things that we're seeing out there currently because of the extreme volatility with the market, right?
Awesome. Yeah, a lot of really, really great points there. I appreciate that. Are your projections for rent growth, are they still, it sounds like they're still easily covering, these pricing increase, which is why, I would assume prices are still continuing to rise despite, interest rates and other variables.
Yeah, so rental rates are still increasing, is what we're seeing here lately. So we look at lease trade outs, we're still getting 15, 20% or so, right? Now the one thing to really think about whenever it comes to lease trade outs is that it's not sustainable. We can't do 15-20% ongoing forever. So at one point it's going to level off, and so if you're assuming that you're going to be getting 15-20% year over year for the first 2 or 3 years, then you may be in for a little bit of a trouble. So we look for we have access to CoStar, we have access to RealPage. We're looking at different sources, and trying to understand what they're projecting, and if they're 7-8%, we try to be a little bit more conservative. We always ease on the conservative side every time we're looking at deals. And so 7-8%, then we're going to be underwriting for 4 or 5%, 6%, right, in that range. just depending on the deal and the upside on it as well. So, we try to stay below what we see out there, and definitely we're not underwriting those lease trade outs. I mean, I think that's good, and it solidifies a potential deal, and it solidifies, the aggressiveness that we could, have towards a deal. But we certainly don't underwrite the full lease trade out number.
Yeah, absolutely. No, it makes perfect sense. And it's still very, very important to err on the conservative side, right? That kind of maybe 3 to 5 range, despite, actual numbers right now being 15 to 20, like you mentioned, because it's not sustainable. And not only that, you don't want to over lever, right? Because eventually it is going to reach that point, like you mentioned. And then that's when we're really going to find out who was truly conservative in their underwriting and who was like, oh yeah, we're going to enjoy this 20% increase for 5 years.
Yeah. So another thing early in the business, we would see, deals, and we would, make offers, and some of the deals that we have are have also assumed this, where, we're looking at rent assumptions and maybe some other income items, right? So nothing too drastic, right? We're kind of looking at what they already have now and keeping it going, right? And that was sort of from a high level how we underwrote, right? But now, and then going back, we would save some of the other income items. Like maybe you're doing Wi-Fi, maybe you're doing covered parking, maybe you're doing washer dryer connections, maybe you're doing reserve parking, multiple different things. We'll kind of save those for the back pocket, right? And if you had to be a little bit more aggressive, hey, take one out, use it, underwrite for it, and then hey, I can get to my number. But now it seems like you have to put everything on the table, right? And you're turning all the knobs, you're pulling all the levers, and even then you're still not enough, right? So I feel that it definitely is an aggressive time out there, and you have to really, anytime you're looking at deals and you're underwriting and you're making offers, you have to make sure that you're going and you're basing those offers based on your true underwriting, and not your ego. Because if you're looking at the spreadsheet, and yes, the spreadsheet can lie, right? Because you're going to input something and it will give you what you wanted to show. But if you really truly believe your spreadsheet, and you're going off of that and say, hey, this is where I draw the line in the sand, I'm not going to go anything further than that. Then versus guys that are like, what, I could beat Jonathan. Who is this guy? Like, I'm going to beat this guy because I'm Juan Vargas. Like, he should have beat me, and I'm going to offer an extra 500 grand. I feel like a lot of guys are doing that because they have the ego, and they want to be able to win the deal. It's a lot of ego, I think, out there, and that's where you can get into trouble, right? So just stay true to your underwriting, and don't go too off of that, and I think you'll be fine at the end.
Absolutely. It's so cliche to say, but if you just try to hit singles and every once in a while you'll hit a home run, then when things really do get hard, you'll be set up just right. Because listen, I don't think 08 is going to happen again to that degree. I think there'll be correction in some form or fashion in the marketplace, right? It kind of has to. We don't, that's just how things go. But you hear so many horror stories of people just being over levered, too aggressive. And then in 08, they went from, I can't tell you how many guests had a $10 million net worth to negative $5 million net worth, seemingly overnight. And so those are kind of the things that you have to keep in mind and work toward, and focus on in your underwriting to make sure that, as you continue to do deals, you're not putting yourself in a bad situation. Because, when the banks come calling and you can't answer, there's nothing you can do. So.
Yeah, that's a great point. And it doesn't help that expenses keep going up as well, right? So you're seeing insurance prices keep going up. You're seeing especially in Texas, right? Maybe in Utah where you're at is not as aggressive, but
it's not quite as expensive for sure for insurance.
For insurance, but then with property taxes, that's another one, right? Property taxes in Texas it's crazy. And so, you're buying a deal and they're reassessing or trying to reassess it at 100% of your purchase price, right? Or even over. So Texas is a non-disclosure state, so we're not going to really, what that means is that we're not going to disclose what we paid for it, right? But the counties, they all have access to CoStar, right? I'm pretty sure they pay a couple $1,000 a year to have access to CoStar, even though CoStar doesn't show you all the pricing details, it certainly shows you, it can show you that, but they'll have a lot of details. And so what they'll do is they'll assess it higher than your purchase price, right? And then, then you're trying to fight it. It's like, hey, I didn't pay 20 million for this thing. I paid 17 million. Okay, well, that's fine. Well, then show me, prove to me, right? And then, at the end, you're going to settle at your purchase price, right? Because they're trying to assess it higher than your purchase price. So it just, we're at a time right now where everybody's trying to get theirs, right? And so it's very tough, and you gotta be careful out there. So just make sure that you're crossing your T's and you're dotting your I's as much as possible.
Totally. Yeah. This is really where we're going to start separating, the experienced or not even necessarily the experienced, but I guess the smart ones, right? The ones who are doing it correctly is probably the best way to put it. And the ones who, have been enjoying that 27% rental increase for the last couple of years, in some of these markets.
Yeah.
Sure.
And we were just talking about like acquisitions. I mean, this is mostly acquisitions, right?
Right.
I mean, I think you got to buy right, but then another big piece of that is make sure you operate right. And
Yes.
And so anybody can buy a deal, right? Just throw a number out there and raise some money and then put it together, and now you have a deal, right? But operations is really the key, and that can really make or break certain guys out there, right? So it's very, very important that you try to have the entire package as best as possible.
Any big changes you're seeing on that end in terms of executing business strategies?
Yeah, so executing business strategies. I mean, I would say we talked about CapEx earlier on the show. I would say that that's one thing that we've seen that has continued to creep up. We used to see renovations at an X number, and now we're seeing Y, right? And it's like the same kind of material. But why is that? It's because of same thing we talked about, right? Shipping, materials, a lot of supply chain issues, and you're seeing a lot of that. So make sure that you leave that, you have that buffer in it. Expenses. There's a lot of things you can do with expenses to try to reduce. And I think it's to your benefit that you do, and you do it as soon as possible, right? If you're going to do a water conservation program, try to do that like day one, right? If you haven't budgeted in already, no point in waiting for a year to try to save then. You do it day one, right? As soon as possible, right? So just got to try to be as efficient as possible, and watching over your KPIs as closely as possible to make sure that you're not letting anything slip through the cracks.
Absolutely. Yeah. And just being weary, right? Prices are going up. So, don't think you can automatically just step in and start cutting costs, because it may not always be available. Right. So it's important to understand every aspect of the business strategy and, what good execution looks like, and obviously having a good team and good partners that you can do that. So we are kind of coming up on time. I will mention that Juan did have some furniture delivered a little early, so obviously that part won't be in the podcast once it's edited. But yeah, we did have to take a small break. He had some furniture delivered a little earlier.
Yeah, my apologies there.
No worries. I'm only teasing.
Yeah,
cool. Well, I do have
good.
5 questions I ask all of my guests. It's the final
Sure.
5. First one: best advice you've gotten from a mentor.
Multiple different things, but it wasn't necessarily from a mentor, but start now, right? And you hear this all the time, right? The best time to start was yesterday. The next best time is today, right? So if you didn't start yesterday, then start today, right?
Gosh, I love that so much. It's so true. I harp on that so much. What is it about your career that makes you feel like you're fulfilling your why?
I think it's because I was already working towards that before. And I think it's, if we have that goal in providing and giving back, from the very beginning, you have that mindset, then, no matter what career that you're in, it's just going to amplify it. So I think it's because I was already doing, what was in our heart and what we desired, right? For charity and for giving back and providing.
Absolutely. Yeah, I love it. So true. We talked about offline, like writing a book and being able to provide value for people. and how important that is. Speaking of books, favorite non-real estate or investment related book?
So favorite book that one of the first books that I read was Emerging Real Estate Markets and Multifamily Millions by Dave Lindahl. That was a solid book. It was one of my first multifamily books, or two books. And then, as far as non-real estate related, I like The Slight Edge. I think that's a good book. I mean, there's a bunch of books out there, but that I could go on and on with. But The Slight Edge was a good book. And, it just, from a high level, it's, just doing something every single day that'll inch you closer to that goal, right? And you're not going to get results, from one day to another, but every day your actions will push you towards that long-term goal. And, it's just a good, insightful book. And, I think it's a book that, everybody should definitely have in their library.
Totally. I love that mentality. What do they say? Like 1% better every day, something like that.
Yeah.
Yep.
Mm-hmm.
If you could have any superpower, what would it be?
Oh, that's a great question. Very good question. I haven't really thought about, but I mean, I would say that, not getting impatient. I think, for lack of a better answer, I think not getting impatient because, it can be frustrating out there when things don't go your way, and that's the life of an entrepreneur, right? And so, if you can, really learn to have a little bit more patience with things, whether they don't go your way or they're taking longer than you expected to take, just know that keep pushing along, and results will come, and your goals will come as well. But you got to just hang in there.
Absolutely. I couldn't agree more. Patience is definitely a superpower, and it's not one that I currently possess. I'll be honest.
Yeah, I think it's one of those things, one of those traits that, I think most people would say that, will hate to admit that they don't have enough of, right? I will say, I'll be the first to say I don't have patience, especially when it comes to the business, and because I want results, I want things to get done now. But that's, if you can be patient, that's a superpower, as well.
Totally. Couldn't agree more. Awesome. Last one. What's the best way for people to get a hold of you and learn more?
Yeah. If somebody wants to get a hold of me, they can reach out to me via email, Juan@genwealthcapital.com, or, happy to connect with them via social media. So at the Juan Vargas, you'll find me on social media, all the platforms: Twitter, Instagram, Facebook, LinkedIn. But happy to connect any way that anybody can reach out to me with.
Awesome. Juan, thank you so much for your time. Really, really appreciate it.
Hey, Jonathan, certainly appreciate you having me on, and hopefully your audience was able to pick up a couple of things from based on my experience.
Absolutely. No, incredible insight. Thank you.
Thank you so much.
Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.